Hey everybody, welcome to today's lesson. We are doing our weekly coaching session for the strategic day trader members, room members, and also doing a lesson series that we are sharing with Facebook and YouTube. Before we get started, I want to say that whatever we discuss today is for educational purposes only, nothing to be construed as a recommendation to buy or sell any securities. With that said, let's go ahead and get started. Last time we talked about what I like to call the atomic unit, the way in which all stocks move. It would take me too long to really go over this to review the entire lesson from last week. So hopefully you can just watch the video if you haven't already from last week. The point of it is to say that stocks move in a four-stage cycle. We call that the basic unit or the atom because it's how most stocks move. And the four stages are dominated by certain psychological or emotional states. And we have stage one dominated by the feeling of indifference. Traders are not interested in the stock when it's in a stage one. When the stock is in a stage two uptrend, the dominant emotion is greed, and one wants to be in the stock at any cost. And that's why the greater fool theory rules, meaning so one fool buying it up here still would make money, selling it to somebody that buys it from him up above. And most traders make money during stage two uptrend. Stage three is a topping bearish stage, and uncertainty is the dominant emotion as a growing number of traders begin to doubt the stock's ability to continue higher, and yet not enough bears to force it lower. When the stock finally breaks down into stage four, all hell breaks loose, right? And fear becomes the driving force, the driving emotion. When fear turns into a panic, that means that the downtrend is over or almost over. And then the cycle repeats. So that's the four-stage cycle in which all stocks move. We said the only way to win would be to buy it somewhere at the beginning of stage two and to sell it somewhere at the end of stage two or at the beginning of stage four. Because sometimes people buy it at the beginning of stage two, but they hold it for too long. The vast majority of the time, traders actually buy it late and exit late. They buy it, and this is the most important thing to always know about trading, which is you don't want to buy something after it's proven to you beyond any doubt that it's bullish, because by that time it's too late. Similarly, you don't want to exit a position after you've already lost so much. You want to exit the moment you start to suspect that this trade is not really working out. The moment you feel that it is no good. That's when you exit. You don't wait until you're proven beyond any doubt that it was a bad trade and you get out right here. I have been told by one of my extended family members that he bought stocks during the tech bubble at $250 and $300 but wouldn't sell, and eventually they were liquidated. 4 or 5 stocks were liquidated as penny stocks. His broker just sold them out when he kept, getting margin calls, and they had already dropped below $1. So anything is possible. You don't want to always be thinking, oh, maybe it'll bounce. You never know. So the trading, the thing about trading is that the name of the game is speculation. You want to speculate. You don't want to wait for too long to enter. You don't also want to wait for too long to exit. That's part of it. This is the cycle as shown on a monthly chart, right? It's easier to see it on a large time frame because it shows you the 4 stages, all of them. The stage one, right? The narrow bars because people are not interested in it, so it's not going anywhere. Stage two, the uptrend. Stage three, the top. In this case, was just a V pivot. And then stage four, the downtrend. And then the cycle repeats. But you can see the same cycle on every time frame, regardless of the time frame. 1 minute, 2 minutes, daily, this is a daily chart, monthly, doesn't really matter. Okay, so that was last week's lesson. We also talked about how stocks don't move up in a straight line. They move up in trends. So on the way up, they actually, let me show you, they don't go up in a straight line, they go up, up and down, up and down. But on the way up, they have higher lows and higher highs, higher pivot highs, higher pivot lows. On the way down, they have lower pivot highs, lower pivot lows. And then when they're basing, obviously they have equal highs, equal lows. In a stage 2 uptrend, the thing to do is to buy the pivot lows, the pullbacks, like so. You buy the pullbacks right here, or, and then right there, you buy the pullbacks, or if the stock also sometimes it stair steps higher, so you can buy the breakouts. Base breakout, base breakout, base breakout. If it pulls back, you can buy the pullback. So depending on how the stock moves up is how you should do it. In a stage 4 downtrend, the opposite. You sell short the counter rallies. You sell short the counter rallies or base breakdowns, depending on how the stock sets up. And so we talked about last week. We talked about the characteristics of uptrends and downtrends. And today we are going to talk about transitional analysis, meaning how do you play stocks when they transition from stage 1 to stage 2, from stage 2 to stage 3, from stage 3 to stage 4, and from stage 4 back to stage 1. This is called transitional analysis, and I like to call it the metamorphosis of stock prices, because the truth is when stocks move from one stage to another, it's like a different stock all of a sudden. It becomes like one day it's going sideways, not going anywhere at all, and breaks out and never looks back. And then when it turns bearish, it's bearish, 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 bearish. I mean, it just changes. It's almost overnight. Sometimes just one day is all it takes for the stock to bottom out or top out, and then it completely changes. It can go from being the most bullish stock in the world, went from $10 to 100, and overnight tops out and then totally bearish. So how do you play these transitions? Okay, we're going to talk about that in today's lesson. Let's see, Craig. Let's see. Okay, good. I'm glad you liked the lesson. Want to just mention before we continue that for new members only, if you're interested in joining me in the trading room for $49, it's yours for the next 30 days. Okay, next 30 days for $49 only. Okay, link in the description of the video. Okay, on to lesson 6. In this section, we show the trader how to dramatically increase the odds of success by understanding transitional phases A, B, C, and D. Understanding transitions will make sure that the trader plays on the right side of professional market makers and specialists. Trading truly becomes closer to a science once one knows how to properly identify and exploit the moments that provide opportunity in the 4 transitional phases. In fact, the highest degree of mastery is attained once the 4 transitional phases are mastered, as they represent the most unpredictable and volatile segments of the market cycle. At the same time, the most profitable. Risk is always proportional to reward, or reward, I should say, is always proportional to risk. When the stock is most volatile, it's also when it's most profitable if you can nail it, if you can get in at the right price, right time, right location. In this lesson, we show you how to identify the earliest moment when one stage may be changing to another. In the next lesson, we show you the strategies to exploit that knowledge. So let's go ahead and get started. So just so we're on the same page, what we're looking to do, always keep this in mind, what we're looking to do here in today's lesson is understand how to play the 4-stage cycle. We talked about how to play the uptrend. We really didn't talk that much. And we talked about how to play the downtrend last week, right? We also even talked about how to play the bases, to buy the bottom and sell the top. But now we want to talk about, 1 second, we want to talk about how, so here it is again, this is what we're looking to do. We're going to talk about how to play the transitions. This is called transition A at the bottom, when the stock breaks out into into stage 2. When stage 2 ends, that's called transition B. And when stage 3 ends, that's called transition C, and you get the breakdown into stage 4. Transition C is the same as A. And when stage 4, the downtrend ends, you get transition D. And transition D is the same as transition B. So as long as you learn A and B, you can actually automatically, you've learned C and D, except in the opposite direction. Okay, so transition A is this. The way to play it is you can play the initial breakout right here. Buy the stock breaks out above major resistance. This represents an excellent buy point from both a trading and an investing point of view. So as a long-term play, as a transition A long-term hold. And then that's the first way to play it. But sometimes if the base is questionable, it doesn't look perfect, doesn't have a nice curling rising 20 like so, then I usually pass on the first entry and I pass on this entry and I wait for a pullback. But I wouldn't wait for a pullback if the play was perfect. Only if it was questionable, because breakouts do have lower odds than pullbacks, but sometimes you never get the pullback. So if the base is perfect, I would do the first entry. If it isn't, then wait for the first pullback, which happens when the stock corrects or pulls back towards the initial base, initial breakout point. This represents the safest buy point. The safest way to play a breakout is actually by not playing the breakout and by playing the pullback. Again, let me repeat that. The safest way to play a breakout is by passing on the breakout and waiting for a pullback. The caveat is it sometimes doesn't come. Or if you get the pullback, it comes up here. By that time, it's already too late. Stock has already moved up so much, it's too extended, overbought, right? If it pulls back to the top of the base, that's called minor support. The top of the base, resistance once broken through to the upside, major resistance broken through to the upside, becomes support on a pullback, just like a ceiling becomes the floor when you land on it, right? So this represents the safest buy point, in addition to it being a second chance to jump on board an accelerating stock. The secondary breakout, which happens here at number 3, the stock moves above its prior peak. Buying at this point should only be done by the intermediate term trader if trading on end-of-day time frames. It's usually too late for the short-term trader unless the secondary breakout is occurring in a much smaller time frame. So this is more for investing. When you're looking at playing daily, weekly charts, you can do it here if you want the extra confirmation. Or for day trading is okay if the distance between the entry up here and the stop right here is very tiny. When you're playing it on small time frames, it's okay to buy it above the prior pivot high, because generally speaking, you only play above the resistance when it's a base breakout. If it's a pullback, you buy it on the pullback right here as soon as the stock turns up. You don't buy it after the stock rallies up to the prior high and buy it up here. That's usually too late. By that time, the stock will have rallied too much already. But what we're saying here is this gives you extra confirmation, and if we're looking at it small time frames, really small time frames, and the stop was still small, then you can do it here too. Otherwise, this entry is reserved for long-term trading. Shortly after the stock breaks above the prior resistance, as the last batch of buyers finally rush in to buy, usually you get a short-term top right here. So the stock comes in, and that's why we say the T3 train trader or the T3 trader typically buys at 1 and at 2, but often looks to sell shortly after the third event. All right, so that's transition A. Transition C is the same but to the downside. You get the initial breakdown under resistance, which represents an excellent point or an excellent entry point from both a short-term trading and investing point of view. The first pullback or the first counter rally. The stock corrects or pulls back towards the prior breakdown point. This represents the safest entry point on the short side, in addition to a second chance to jump on board a rapidly declining stock. And in the secondary breakdown, which is, as we said, is usually too late unless you're an investor or looking to hold for a long time to come. All right, so that's transition C. So we're going to learn about now transition B. We talked about, so here's the four-stage cycle, the atomic unit. We talked about A and C because they're basically the same. Now we're going to talk about B and D. But in order to learn about B and D, you have to learn how to draw the proper trend line. So here's how to draw a proper trend line. You start by marking the major low. You don't need to remember the names. I'll summarize this in just a second, but let's read first. Start by marking the major low, just below the highest high. This is called the anchor and will only change when the stock makes a new high. This is called the anchor and will only change when the stock makes a new higher low, another pivot basically. Find and mark the lowest low of the current upward move. This point is movable to the lows above it if there is price interference. When you connect them, if there is price interference, meaning if price actually breaks this trend line, then you can't use the lowest pivot low. You have to use this one. And the trend line would look something like this. Of course, yeah, it has to be a straight line, so it would look something like this. It'd be similar, but not the same necessarily. Connect these 2 points to form your upward trend line, and then step 4 is you extend into the future, because anytime you get a buy setup at the trend line, that gets 10 extra points. Because a buy setup at the trend line is basically the same as a buy setup at the rising 20 MA. That's the exact right location to look to play long. Note there should be little to no price interference between the 2 points. So one more time, you have this uptrend, whatever it is, looks like this, let's just say, and you want to draw a trend line. How do you do it? You find the highest pivot low, which is this. You find the lowest one and connect the two. If there's price interference, then you have to use the pivot that breaks the trend line. Otherwise, you can just connect the two. Let me show you, trying to get the annotation tool to the right spot. And it goes up to, my annotation tool is stuck, so I'm going to just go ahead and start over. Let's say you have this trend. Here it is. How do you draw a trend line? You have to connect the lowest with the highest. But as we said, if there's price interference, you can't use the lowest. In this case, there was. So that's not the right way to draw it. You'd have to connect this one with the last high pivot high, with the highest pivot high. I'm not sure why my annotation tool is freezing up on me. So I trust you understand how to do it. And when you're connecting a downtrend line, it's the same. You find the lowest pivot high with the highest pivot high, connect them, and if there's price interference, then obviously you'd have to redo it. Okay? And step 4, again, is the trend line is extended into the future, because if you get a sell setup at the trend line, that is basically, it gets like an extra point. Or when I'm ranking my trades, it becomes, I upgrade the trade. The setup. So now that you've learned how to draw the trend lines, let's read some notes. The key point to remember is that unlike traditional trend lines, T3 trend lines are evolving indicators. They are changed with each new high and low, right? They can be changed if there's price interference. It is also important to understand that T3 trend lines help the trader to monitor the flow of funds in a tradable item. In each case, the trader would primarily focus on the strategy of shorting all rallies toward the downward trend line and buying the pullbacks to the uptrend line. The trend lines indicate, they basically tell you whether money is flowing into the stock or out of the stock. That's what they are. Trend lines, and they also give you the rate at which money is flowing in or out. That's why stocks react to trend lines. Prices usually, trend lines, when the stock is trending nicely up or down, trend lines usually hold because the stock is usually, going at 40 miles an hour, 50 miles an hour, or money is flowing in at 40 miles an hour, 50 miles. Does that make sense? So you get the same flow, inflow or outflow. Lastly, T3 trend lines also provide the trader with the earliest possible indication of change, which is the most important thing about trend lines. So they give you the earliest possible indication of a change in the trend, of a break of the trend. This leads into our next discussion, which deals with what action is taken when the T3 trend lines are broken. All right? So a downward trend line tells the trader that the flow of money is generally moving out of the stock or the market, and that the best odds exist on the short side, while the upward trend line say the reverse. So here is how to play transition B. Remember, transition B happens at the end of a stage 2 uptrend. So the stock was in an uptrend, and you've drawn hopefully your trend line, and when the stock breaks the trend line, the initial break, this occurs when a stock breaks below its upward trend line. However, this is not an action event. It's simply an early warning of a possible trend change. It's loss of momentum. You have a stock again that's going up at 60 miles an hour, and all of a sudden it comes in really hard, slows down big time. So it's a warning. The first pullback, this occurs when the stock moves back up towards the prior peak and fails. Fails to what? Fails to make a new high, because the definition of an uptrend is higher highs and higher lows. So when it fails to make a new high, this becomes an aggressive action event that calls for a short. So this is how you play a double top, basically. But I wouldn't go around shorting every rally that fails to make a new high. Let me show you. I'm just going to restart my annotation tool here and see if that fixes it, because you don't want to, again, here's an uptrend. Let's say, you get the deep pullback, breaks the trend line, you go up here and you short the double top. Well, what if it continues higher? And you tell me, well, it was a double top, I shorted it. What's wrong with that? So you have to be careful, because most trends, when the moment they break, they go right back up. So you cannot just short any prior double top. You have to do it. There are some rules around it, such as you can do it if the initial break here also breaks 2 or more support levels. So if it was a really deep pullback, then a double top is okay to do. Number one. Number two is, and this is how I use it most of the time, is if we're using this as a way to finesse, to perfect an entry into a larger time frame. For example, the 15-minute chart is already triggered a sell setup, but the 5 is still in an uptrend. Well, you can do it, you can get into that stock short on a double top on the 5-minute if the last sell-off on the 5-minute chart actually triggered the setup on the 15. So again, I use it sometimes as a way to perfect my entry, to get it at the top on a smaller time frame inside of a larger setup on the larger time frame. Okay? So if the first move broke multiple support levels, then the stock is said to be in an automatic presumed downtrend, and the next sell setup is playable. If it is an issue of multiple time frames and you're trying to perfect your entry, you're getting in, let's say, on a 15-minute sell setup, but you're using the 5-minute chart as a way to get in with a tighter stop, a better entry. What else? If the last pivot high was solidified by something else, such as a flat 200, a declining 20 MA, if the last pivot high signified major resistance, meaning there were actually more than one pivot, like 2 or more. If there's 2 or more, then the third time you can always do it, because that becomes major resistance. So I've given you at least 4 so far times when I would look to do the transition phase B. Transition phase B and D are very hard. They're not as easy as A and C. unless the stock totally goes climactic. When the stock is up a lot and accelerates and goes climactic, then it's easy to do it at the top. Becomes just get in under the last bar's high. Don't wait even for the double top. But that's transition B. Transition D is the opposite. You have the downtrend line, and the initial break is an early warning that the stock is no longer as bearish as it once was. But it's not an action event. The retest and failure to make a new low is, or the double bottom is, an aggressive event that calls for a buy. Okay? Any questions about this? You guys in the room with me, let me know. On YouTube, Facebook, I can see the questions later, but hopefully everything is clear. So transition phase D. Now, you can also, this is a way to summarize the only 7 events that you can have. The only 7 events. And this is based on the basic unit or the atomic unit. You can have an uptrend. So stocks can be either in an uptrend, you have an uptrend, a downtrend, or a sideways trend, stages 1 and 3, right? Uptrend, downtrend, that's stage 1, stage 2, stage 4, or stages 1 or 3. Now the uptrend, because it's in an uptrend, it can break through the uptrend line break, right? And then the double top. The downtrend can end through the downward trend line break, and then the sideways trend can break out or down. So you get the breakout and the breakdown. So again, the only 7 events that can happen. There are 3 trends: uptrend, downtrend, sideways trend. The sideways trend can break to the upside, you get the breakout, or to the downside, in which case you'd get the breakdown. And the uptrend is already in an uptrend, so we can't say it's breaking out, it's already in an uptrend. So you get the uptrend line break, and then the downtrend, you get the downward trend line break, and that's transition D. So transition number 6 would be transition B, transition D, and number 4 would be A. So A, C, B, and D. A, C, B, and D. We as traders must know each and every one of those events. Knowing the 7 events ensures that the trader will rarely be thrown or lost by anything the market does. These are the building blocks of all market activity. There are no other market actions to understand. These are it, basically. So must learn them. And with that, we come to the end of today's lesson. I hope you enjoyed it. As I said, if you're interested, there's a link in the description of the video where you can join me for the next 30 days and trade earnings season with me, the most lucrative part of the year, for the next 30 days for only $49. You learn a simple and accurate system designed to teach you how to trade with a vision that is clear and unclouded by emotions, objective. Okay, not hocus pocus stuff. Believe me, because I'm saying it, because I'm a market wizard. No, it's all based on reading price action objectively. You also become a part of the 2-time winner of the best trading room. We won it 2 years in a row when we had that challenge going on, and where the trading public actually voted for. It was called the black room at the time. Now it's called the strategic day trader room, but I was running it just as today, and running it in a as a professional day trading room. So again, if you have any questions, contact customer service. But if you're interested, you can join me for the next 30 days for just $49. I hope you enjoyed today's lesson and have a wonderful evening. Talk to you on the next video. Take care, everybody.